Today, we've got a packed agenda: US GDP surprises, PCE data, bond market moves, volatility signals, tariff news, and how all of this fits into the buy the dip game plan into June, and more specifically, the June 20th OPEX. Ready? Let's jump in. First, last week's GDP print, it came softer than most expected, what I'd call a stag-flat growth. We saw weak expansion alongside rising prices, and that's a bit puzzling because over the past few surveys and sentiment indicators, soft data has been outperforming expectations. In a normal world, that would signal a stronger GDP, but last week's did not follow through. We got more clarity with the PCE report. The headline number was benign, but personal income showed some cracks. This is one of the reasons we did not get a rally on Friday and did tilt downwards. Speaking of markets, bond yields actually dropped towards the end of the week thanks to the Treasury's long end buybacks, which actually kept rates. You might have noticed the TOT popped about 1%, and this lines up with the Fed quietly backstopping auctions since April. Think of this as a subtle form of QE. Technically, TOT is still stuck as Q is still a bit bearish. Unless yields fall back further, the pressure remains. On the volatility front, VIX term structure is steepening, and what that tells us is an uptick in volatility can be expected. If we peel back the layers, however, there's a heavy pull towards 20 and very little put protection out of the money, which tilts the market lower. Only a sustained break above 20 would flip this dynamic. And don't forget, the month-end rebalancing close. Goldman Sachs estimates US pension funds have dumped about 19 billion of equities on Friday, and that actually ranks in the 89th percentile of sale estimates over the last 3 years. Now, on to the geopolitical angle. The US Court appeals just reinstated those Liberation Day tariffs, but most banks call it a nothing burger. In practice, the administration still has tools to press forward, so little should change, though uncertainty itself is not great for planning. Meanwhile, trade talks with China are reportedly progressing slowly, which is an actual quote, and even stalled. And if negotiations totally break down, we could revisit those 5610 levels on the S&P 500. But for now, that's not the base case. Technically speaking, the S&P tried to clear the 6,000 resistance, but faded quickly. We still held above the 9-day EMA, with the 21-day EMA near 5,800 acting as solid support. On the upside, 6,000 is a major obstacle, and we've got 2-week high resistance around 15,975. And what also needs to be noted is the QQQ also saw a failed breakout and is trapped under the resistance zone, but is still hanging on to the 9-day EMA. What does all of this mean for your trading? Well, base case: expect more downward pressure at the start of the week unless we get some surprises from Trump. However, dynamics remain supportive into June OPEX on the 20th, so any pullbacks in indices like, for example, the SPY are likely buying opportunities. That said, individual stocks could see varying outcomes, and some names already show signs of being overextended, and they might need a sharper correction before they look attractive again. So here's the game plan: stay patient, watch your levels, and be ready to act around those key EMAs. Don't overreact to every blip, and always manage risk in these choppy conditions, as this remains a news-driven market. All right, so that's our lens for today. Thanks for tuning in. If you found this helpful, hit like and drop any questions below, and of course subscribe. I'll see you next week. Trade smart.